Welcome back to Closing Bell. The World Bank cutting its outlook for global growth, issuing a new forecast of 2.5% global growth in 2020 due to a slower than expected recovery in trade and investment. It also forecasted that growth rates for advanced and emerging markets would diverge even further to 1.4% and 4.1% respectively. Here to break down those numbers in a First on CNBC interview, Ayhan Kose, World Bank Director of Development Prospects and one of the authors of this report. Ayhan, thanks for joining us today. One of the things that really got my attention in this is the fact that you say that this rebound is not broad-based and that actually a third of emerging market and developing economies are projected to decelerate this year. Where do you see the strength? Where do you see the weakness and why?
So first of all, there is modest acceleration in growth, and this is good news. So a large part of this acceleration is going to be driven by a small number of emerging and developing economies. And these economies, some of them had recessions, some of them had deep slowdowns last year. So overall, we see growth picking up, and that is the good news. Trade tensions moderating, financial conditions remain accommodative, and relative to where we were last year in January, we are in a much better shape. We are coming out of 2019. Global economies saw the lowest growth since, global financial crisis. So this modest acceleration is good news. At the same time, we downgraded our forecast across the board in advanced economies, in emerging developing economies. Of course, growth projections are weaker, but there is acceleration, and that's welcome development.
What's your forecast for the U.S. and what are the key swing factors you're watching for that could make it weaker or stronger than expected?
So for the U.S., there is moderation in growth. We are expecting growth to be around 1.8%. Relative to last June, we actually marginally upgraded U.S. forecast by about 0.1 percentage points. We think that recent developments in terms of reduction in trade tensions should help. And we also think that the manufacturing and investment growth could pick up in light of these developments.
We will leave it there, Ayhan. Thanks so much for joining us.